NVIDIA
and AMD
have agreed to pay
50% of sales into US Treasury
in return to sell into
China.
China's telling firms not to buy the H20 chips, raising all sorts of questions.
Of course, which we can certainly talk about.
Your administration agreed to send the most advanced or advanced NVIDIA and...
If you didn't notice, it took Donald Trump 1.18 seconds to respond negatively. This comes as reports indicate that NVIDIA and AMD have made an agreement with the United States government to receive access to the Chinese markets in return for 15% of revenue generated in China. And since this news broke, AMD and NVIDIA have experienced roughly a 3% decline. While the agreement enables greater access to competitive GPU and CPU markets, the market has largely responded with caution, reflecting concerns over margin impacts. Analysts, however, have modeled approximately 30 billion in AI chip sales to China by 2027, with order of magnitude forecasts of 0.9 to 1.2 million units shipped, which is consistent with policy analysis indicating around 1.3 million H20s that are currently pending exports. However, when we translate Chinese reports from state outlets, we can see that China's central government agencies, such as China's Cyberspace Administration, isn't pleased with the availability of US chips, indicating that we must not allow faulty chips to be put into service, and that products with security concerns should be promptly removed. This comes as China has accused NVIDIA and AMD to have tracking and remote shutdown capabilities, which received prompt responses from both companies rejecting the accusations. While China hasn't formally banned the products, the message is clear
that a reliance on US chips is not what China is going to be comfortable with.
And is placing bets on its own markets as
China wants technology companies to use the national chip, not to use the H20.
When we look at these markets, we find that Chinese companies in the race include most notably
Huawei,
as well as other companies such as Cambricon, Iluvatar CoreX, and others. While many of these companies such as Huawei are privately owned, we can set Cambricon as a benchmark for China's AI semiconductor sector. As of 2025, its market capitalization reached 423.5 billion yuan, or $58.5 billion, representing a dramatic 54% increase from 2024's 274.5 billion yuan. Furthermore, the enterprise value stands at 422.8 billion, indicating minimal net cash positive, and based on current valuation metrics, Cambricon's 2025 revenue appears to be approximately 5.3 billion, marking significant growth from previous years. However, profitability remains challenging, with the company showing a PE ratio of 364 times in 2025, improvement from the negative ratios of 2022 to 2024, but still indicating minimal earnings relative to market value, especially when compared to NVIDIA's 60 times PE ratio. In particular, what stands out about this company is the price to book ratio, which is currently 63.5 times in 2025, up from 50.7 times in 2024, as well as the EV over EBITDA of 315 times, turning positive after years of negative ratios, and a capitalization over revenue of 79.2 times, showing normalization from 2024's peak of 234 times. These metrics highlight how valuations in China's AI semiconductor sector are driven primarily by growth expectations and strategic positioning rather than current profitability. The 364 times PE ratio, while extreme, represents a significant improvement from the loss-making years of 2022 to 2024, which suggests that the company has achieved basic profitability and show that there is a low probability for the chips to be used in government and critical infrastructure. When we look at previous 10K reports in which NVIDIA and AMD have access to Chinese markets, we see a clear linear relationship indicating a 40 to 80% increase in year-over-year sales in China before full restrictions. This likely indicates that there will be moderate demand for hyperscalers and large state-linked entities such as Alibaba and ByteDance. Ultimately, this highlights that China will be more reliant on US chips at the initial stages than what they desire. However, these large state-linked entities could also launch incentives that defer demand for initial imports. The question comes to mind as Donald Trump says,
and Jensen also has a new chip, the Blackwell. Do you know what the Blackwell is? The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible I'd make a deal, a somewhat enhanced in a negative way Blackwell. In other words, take 30% to 50% off of it. But that's the latest and the greatest in the world. Nobody has it. They won't have it for 5 years. But the H20 is obsolete. You know, it's one of those things, but it still has a market.
Through his body language and pauses, you can infer that the US government is willing to structure additional agreements around other NVIDIA and AMD products in the foreseeable future. While the president mentions a 5-year horizon, there is a meaningful chance that a deal will be made earlier. This is mainly due to aspects that we'll cover in future videos. However, we could also examine different types of products and see if there is a vast difference between them. This would help indicate whether or not Chinese entities would want to defer demand. This next graph examines measurable metrics such as HBM capacity and memory bandwidth, which are critical bottlenecks for AI computational workloads. A composite index combining these metrics provide insight into practical performance, as memory constraints often limit AI workloads more than raw compute power. For Huawei Ascend 910B and Cambricon MLU 590, the results show lower specifications compared to leading Western alternatives. However, with the Ascend 910C and announced Ascend 920, China's domestic chip capacities are advancing significantly. This comes as Ascend's 910C features dual chiplet architecture with 128GB and HBM3 memory, which surpasses H20's capacity. The upcoming Ascend 920 promises 900 T-flops in BF16 performance and 4TB per second bandwidth. While these specifications suggest potential competitive performance with NVIDIA's H20, training efficiency will depend heavily on software optimization, ecosystem maturity, and multi-chip scaling capacities. The AMD MI300 series also offers strong HBM capacity, which is particularly valuable for long context transformers and large batch LLM training, where memory bandwidth becomes the primary constraint. At the very top, NVIDIA's Blackwell B200 leads with 180GB HBM3E memory and superior bandwidth, achieving the highest theoretical composite score. However, since the model won't be available in China, we modeled a hypothetical 50% reduced Blackwell. Theoretically, this model only outperforms the H20 by a small margin, suggesting that NVIDIA and AMD's products will continue to see meaningful demand in China, even as Huawei pushes forward its Ascend line. Currently, US products like the H20 maintain advantages in software ecosystem maturity and proven multi-GPU scaling. This suggests that while China's domestic chips are rapidly closing the hardware specification gap, NVIDIA and AMD's complicit products will likely maintain meaningful demand during the transition period as China's alternatives mature their software stacks. Lastly, when we look at NVIDIA's disclosures on China's export restrictions, the company identified 3 H20 impacts in the first quarter of 2026. First, there was a $4.5 billion expense tied to H20 excess inventory and purchase obligations. In addition to this, NVIDIA recorded $4.6 billion in H20 sales during the quarter before the new licensing restrictions took effect. Lastly, the company reported $2.5 billion in unchipped H20 revenue that could not be delivered because of export controls. Connecting this to the margins, we see that in 2026 quarter 1, NVIDIA forecasts growth margins to be at 60.5% on a GAAP basis and 61% on a non-GAAP basis. And if you exclude the H20 charge, gross margins would have been 71.3% non-GAAP basis. For comparison, in 2025 quarter 4, non-GAAP gross margins was 73.5%, and for 2025 in general, it was 75%. This means that the growth margin fell from quarter 4 to quarter 1 to 2.2 percent points, and full year decline of 4.2 percent points. This is important to note as NVIDIA's expectations for second quarter of 2026 are $45 billion plus or minus 2%, which reflects a $8 billion revenue loss from restrictions of H20 sales. However, the company expects non-GAAP growth margins of about 72% plus or minus 50 basis points and non-GAAP operating expenses of roughly $4 billion. When we look at this from a recovery standpoint, using quarter 1 margin of 71.3%, NVIDIA would need around $6.3 billion in revenue and $6.25 billion using the quarter 2 outlook margin of 72%. Now, when we look at AMD, we find that AMD disclosed a $800 million expense for inventory and related reserves due to export controls. Excluding those charges, AMD reported a non-GAAP gross margin of 54%. To recover that $80 million, we found that AMD would need around $1.48 billion in revenue. However, because AMD runs lower margins than NVIDIA, it has less flexibility to absorb both the inventory cost and the 50% revenue carved out. This makes AMD's break-even requirement environments proportionally more challenging. Both firms therefore face substantial pressure to maintain China's sales volumes, as the inventory represents not only significant capital risk, but also strategic positioning in the world's second largest AI compute market. However, this may become significantly more difficult as China advances towards restricting sales.